and welcome to the Bad News Podcast YouTube channel. I'm so happy to bring you guys this discussion I had about GameStop with financial advisor Mr. Leyder Aiden Murillo. For those of you familiar with this podcast, you've heard from Mr. Leyder Aiden Murillo before. Since the beginning of the GameStop debacle, we had been talking and discussing the questions we were receiving from people interested in all of this and our clients as well. And we thought the best way to answer these questions would be through this platform. In any case, I'd like to give him a formal introduction once again. Aiden is a fee-only fiduciary independent financial advisor and managing director of his firm, Wolfpack Investment Management. He brings affordable financial planning and investment management services to young professionals, business owners, educators, and married couples who want to focus on maximizing their financial goals. There are no income or minimum investable asset requirements. He provides clients the solution to regaining their freedom to focus on what they are most passionate about in life while becoming confident about their financial future by understanding it. So he teaches everything to you guys. He has been in the wealth management industry since 2013. He's worked extensively with a variety of clients from small, medium, and large net worth individuals to large institutional clients. And he's also is a level 2 chartered financial analyst, CFA, exam candidate. I'm so excited to share this with all of you, and I really hope you enjoy it and learn something from all of it. All right. So first off, thank you, Aiden, for agreeing to come back on the podcast. I know both you and I have received tons of questions regarding the GameStop debacle. So I'm really glad we can share this platform to answer most of the questions we've received.
Yeah, I'm glad to be back. Thank you for having me. You know, the last time that I was on your show, it was quite a different experience of what was happening in the real world. So it's totally shifted. So it's good to say that it's good to have something different on our minds now.
Yeah, I agree. So, let's dive right in. You and I have been discussing this whole GameStop thing since it first started. And we've questioned each other back and forth on the ethical ramifications of it. But before we can really dissect that, I think we first need to take a moment and explain what happened to, the whole thing and explain it in the simplest way to our audience.
Yeah, so where do we start? Because it's one of those things that it's like, it's one of those advanced topics in investments, but we'll try to see if we can explain it, because here's the thing. You have an institution out there betting against the market saying it's going to go down in price. Whereas now you have all these retail investors saying, no, that's not right. It's going to go with the market and it's going to increase in price. So how can we explain this? So let me ask you this, Samira. What's a material item that you can't live without?
My phone.
Okay, so let me borrow that from you for the next couple of days, because I've done some deep analysis of the company, right? The company that makes this phone. And it will either come out with a better phone, or it'll go out of business, or they're doing something illegal, and therefore making your phone practically worth zero. And in the end, what I can do also is I'll pay you some interest because I'm borrowing it from you, because you want to be rewarded for it. You're lending it to me. So then I go into the market to sell it. This is how I make a premium. And then I wait 2 days, and you know what? A newer model came out, and that phone is practically worthless. So then I use that premium that I originally got. Let's say it was $100. And now I can buy back the phone for $75. I give you back your phone, I make $25. And then if you add the interest to it that I paid you of $5, let's say, that's a net of 20. I hope it didn't get too confusing there.
Yeah, I think that's as simple as you can explain it. So what happens if your plan didn't go as planned and the value appreciated instead?
Yeah, that's a great question. Well, I would be at a loss, because let's say I got $100 for it when you lent it to me. Then I had to go back to the market to buy it at, let's say, 125. So basically I lost $25. So add $5 interest for that, that's a loss of $30. So you notice how if the value continues to appreciate, it kind of makes a little, puts you in a bind if you are going against what the market is telling you.
Right. Okay. So what if the price starts to move up too quickly and I call you concerned that I won't be able to get my phone back?
Yeah, that's a very good question. So you are concerned because you want this back and you feel like you're not going to get this back. So I either have to deposit some sort of money in good faith or buy the phone immediately from you at the market price. So essentially what you just did was you gave me a margin call. And basically that means, hey, you need to either deposit more money or buy the phone from me or find an equivalent phone and put it in, have it with you in your possession in order for you to feel much more confident. And basically what happened with me is what we call a short squeeze, because I'm being squeezed out of earning a profit because now the price is moving up way too quickly. And therefore I need to either scramble to find this product, at a much more expensive price against me, and I'm losing profits on that type of a strategy trade. So hopefully it made a little sense, but that is as basic as we can try to explain it. But it's a little bit much more complex, and if you want to do a deep dive, I'd be more than happy to explain that in my video that's coming out.
Yeah, no, I think that was great and as basic as we can go trying to explain what it all meant, and I really appreciate that. So now that we understand the basics, let's have you explain what happened with the Reddit users and the hedge funds that were shorting GameStop at the time. And let's clarify why they shorted it and who the hedge funds are. Are they truly the bad guys that the Reddit users are trying to make them out to be?
Yeah, it's like the David versus Goliath type of thing, right? The bad guys are out there and you're trying to go up against them. And so basically, it all started off with someone on Reddit saying, GameStop, it has proven fundamentals. Obviously, the market and the rest of the industry doesn't believe this. But the thing is, if you think about it like this, all of those that are in Reddit right now that are at home because of the pandemic, they're out of jobs, they feel the frustration of what happened back in 2008. So technically, they're putting all this level of frustration of 2008 on these hedge funds because of the fact of, someone lost a house, the value of their portfolio dropped because of the market crash, in a way. So they have this level of frustration. And so they came out storming in gusto against these hedge funds. But in actuality, the hedge funds weren't the ones that found, technically they did find some sort of irregularities in '08. But the thing is, the ones that were to be blamed were the investment banks. Most of these hedge funds actually did the legwork that regulators didn't have the opportunity to find because, they didn't have the power to do it because they were perhaps stretched so loose. So most of these hedge funds probably found this type of negativity, and they were probably out there saying, hey, this is what's happening. So, and then they were probably laughed out. And one of the greatest movies that I can actually let your viewers or listeners kind of connect to this is The Big Short. In the movie, you have one hedge fund going out there saying, hey, is this illegal, what's going on in the industry? And they were laughed out. They were said, hey, you know what? That's how it is right now. This is how it goes. So technically, are they truly bad guys? That's one of the hardest things to answer because it all depends on where you see it. Because if they make money off of it, but yet they're over here, telling you what's going on, are they truly the bad guys? I'm neutral on this. And as you know, I have to remain neutral on it. But at the same time, it's like, okay, it all depends on how you see it.
Yeah, no, that makes sense. And, when you bring up the example of the Big Short, I think it kind of helps people understand, oh, maybe it's not the hedge funds we're really mad at. Maybe it is the investment banks that end up, making all of these bad loans at that time. And, we're frustrated with that. But, so now a lot of people are asking, so what was the goal of the Reddit users? What were they trying to achieve by holding their stocks in GameStop?
Honestly, I think they just wanted to be heard. And the reason why they wanted to be heard was because they have felt that Wall Street has become a way where they make money and the little person ends up not gaining anything. But in actuality, that goal was perhaps not completely thought out because when you're holding now GameStop stock, that's kind of hard to say, GameStop stock, you are literally now stating that the fundamentals of where this company is trading at, whether let's say it's $500, is equivalent to those of big tech companies out there. So in actuality, you may end up hurting yourself because if everyone is saying that the fundamentals aren't there, that can end up even worse for you. Because the thing is, now you're stating that it should be making more than enough revenue and creating more earnings for you as an investor. But in actuality, most of the numbers out there are stating otherwise. So I don't know about you, but the last time that I went to a GameStop was years ago. I don't see anyone out there going, making huge lines out there. But then it's all speculation out there. And that's the key here, where if you're able to speculate, you can buy this stock at whatever price. You can buy it at $1,000 if you believe it's worth $1,000. But you need to have some sort of thesis towards it. And I believe everyone thinks that by holding it, it's going to shoot back up. And this is the drawbacks of what's called a momentum trade. A momentum trade builds up so much steam in the beginning, and then all of a sudden at the end, those that came or arrived to the party are basically the ones that are at much more of a bigger loss. So in essence, holding the stock of GameStop may not have made sense for them. But again, it's whatever they believe and it's whatever they made the thesis of whatever it is that they believe the company is worth. And again, they have every right to say the stock is worth $1,000 if they believe it.
Right. And that's what makes the markets kind of go is, you have people on both sides of the trade, which is very important. And, looking at the fundamentals, and if we just look at the fundamentals of GameStop, their stock shouldn't have been worth $500 at one point. Like you said, the pandemic has definitely squeezed them even more than what they were used to. I mean, as a gamer, as all our gamer friends too, they buy their games online. Who needs a GameStop anymore? So it's unfortunately the truth, but GameStop was kind of that symbol of David and Goliath. So they definitely got all convoluted, I would say. But so, moving on to the ethical parts of this, I think we both agree. I think it's safe to say that we both agree that the risk that the amateur retail investors took on, that was something that was the big ethical dilemma behind all of this. And they were basically told to do something, and it looks like now they've lost the most. And, I understand that they're definitely trying to give, the big bad guys a taste of their own medicine. But unfortunately, they took on a risk not understanding it. So do you agree with that as being the biggest ethical dilemma?
You know what? Yeah, the thing is that in order for you to actually learn something, you have to lose something, right? And just like how you said that in Wall Street or just in investing, there's always someone on the other side of the trade. Someone will always benefit while, you perhaps may not, right? So were they really truly giving them a big bag taste to the big bag guys? Maybe, but at the same time, these institutions, that's the reason why these institutions are out there, is because most of the investors that are part of a hedge fund, they're the ones that have they're considered to be sophisticated investors. So that means that these sophisticated investors can stomach these losses, whereas a regular person may not, and that's the ethical dilemma, is saying, well, why is there some sort of a vehicle for ultra rich people? But at the same time, these are not just for the ultra rich, right? You have pension funds that rely on hedge funds, whereas they provide the future cash flow to when you retire, whether you're in a union or teachers pension, all those things come into play. But the thing is, the social dilemma behind this, the ethical dilemma, is the fact that the amateur investors wanted to be on the same level playing field. But the thing is, they're constrained by how they incur their own salary, their own limitations to their own cash flows. So that's the thing, Is it a taste? Sure, they wanted to be voiced and they were heard, right? But the thing is, now it's like the ones that get hurt the most are the retail investors who do not have the means to continue on and stomach these losses. One of the things that I was going through on Reddit was some people were throwing in there and saying, hey, this is my whole retirement account. You only live once. This is my whole student savings account. You only live once. Yes, you only live once, but now you have to work twice as hard in order for you to regain this money. So it's hard, right? You don't fathom the notion of what you may be doing because you get caught up in this, right? So in essence, is it an ethical dilemma? Sure. But the thing is, who's more at risk here? The amateur retail investor or the sophisticated person that understands the notion of passing this on to a professional to handle their money, right? So
I'm really glad that you brought up the pension fund side of it. And that's a whole other, dilemma that people can talk about, like, why are pension funds part of hedge funds? And right now, unfortunately, with the low interest environment, that's one of the only ways they can produce a cash flow. But that's a whole different argument. But at the point of all of this is, at the end of the day, it's ending up hurting us, the retail investors, in multiple ways. So a lot of people lost their money. And now if they were trying to, make these hedge funds collapse, they might have lost, parts of their pension account. So, there's a lot more to this than just, oh, I want to get back at Wall Street. There's a lot of other, things that people need to consider too. So I'm really glad you brought that perspective up. And so, moving on, from my perspective, it seems as though, this is just the beginning of more to come from retail investors. Do you share that same sentiment?
100%. And here's the reason why. Now that they understood the risks and the nature of how the stock market works, that's going to put them more interested into learning more. Now, the question is, do they want to make their own informed decisions or pass it on to someone else to, make this informed decision? Retail investing is here to stay. And platforms like Robinhood has made it much more feasible. And that's another topic that we can discuss, because you and I both know about our own, we've gone back and forth and have discussed that of Robinhood, but let's not veer off into that. But I do believe that retail investing is here to stay. And especially since, the whole notion of they got the taste of, if they were able to, win big in the beginning, because obviously in order for a momentum trade to work is if you get in the beginning and get out in the beginning. If you are towards the end of it, you are at the very, very end and you're last to the party. So They got, the taste of both the good and the bad. So again, who ends up winning here? Both sides, right? One side wins, one side loses. So in order for you to actually learn from this, you more than likely will learn more from it if you lose from it. But you will continue on pushing further if you continue winning. The probabilities are against you though, because we all know that you can't always keep winning, right? So yeah, retail is going to be here to stay. And I have a feeling that they're going to perhaps keep voicing their opinions like they have with Reddit. So no one knows exactly which other company is going to be out there that's going to, perhaps spike up in price. Is it even possible again? Sure. The probabilities of it working out again, probably minimal now.
Yeah, no, it's a very good point that you've made. And at the same time, we want retail investors too. We want those to come back because it helps the markets become more efficient. You have people not following a big trend of like, oh, this stock's going to fall or that company is undervalued. You have different perspectives, different opinions, and that makes the market more efficient. So on one hand, I'm really sad that this happened to all these retail investors, but on the other hand, they've created a trend now that's actually going to help all of us at the end of the day. So I'm really happy about that. But for our viewers that, might have gotten involved with this short squeeze, what advice would you give them right now?
Wow. So if you were able to stomach the whole notion of, if you're still in it from the beginning to end, my kudos to you, because I think the last time that I checked, the stock was like at 80. So imagine going in at 450 and now you're down at 80. That's a big drop, right? But if you were able to begin at the beginning, ride it up, and you were able to get out at the right time, this is what market timing does. Is more kudos to you because you were able to get a gain out of that. Now, if you were at the very end of it, take this as a learning perspective of it, because you can't time the market, and especially if you day trade. Day trading is not meant for the individual that's busy, or that is just going to think, oh, if I leave it there, by the time I come back, it's going to shoot back up. It moves much more volatile. It moves way up and down crazy. So it's not for the faint of heart. So in essence, if you were able to get in the beginning and out in the beginning at the right time, kudos to you. You made something. Will this happen again? Probably not. The probabilities of another thing coming out like this may not happen. And then if you did end up at the very end of the party, as I like to say, just take it as a grain of salt, as knowledge, and hope to learn from it, of not going into a trend type of momentum trade. Because if you get caught up in the wrong side of it, you can easily lose, and it's hurtful. That nobody really likes losing, actually.
No, not at all. So yeah, that's some good advice. Do you have any other advice for, our other listeners that may not have gotten involved in this?
Yeah, so basically, again, the investing is out there for everyone, as I like to say. And, since I am a financial advisor, that's why you brought me in the last time. All I can say is, if you do want to begin your own investment account, it's easier now because of different platforms. And it's up to you to make that informed decision if it's for you to do the research, do all these fundamentals, do all of this, do all of that, because it does take time. So now imagine working from home or having a family, and you're trying to over here manage your portfolio, your own money, and it's time consuming, and we can't do everything right now, right? So you have to make that decision. If you do have the time for it, that's great. Learn more from it. There's educational videos out there that tell you how everything kind of works. But make that decision, whether do you want to continue. If you are currently managing it right now, move on forward. Are you managing it or pushing it off to a professional, saying, hey, you know what, this is too much for me. I'd rather not deal with it. I'd rather have my time back, type of thinking. So that's all I can really advise listeners and viewers. The other thing that I'd like to just point out is just think about the story of the tortoise and the hare, right? If we all know the tortoise and the hare, if nobody really knows it, the story, I don't want to give a spoiler alert. Well, you kind of have to, but the whole notion is that you can't expect things to move up too quickly, right? If it moves up too quickly, then something is wrong, right? If you're slow and steady, you know, as the saying goes, slow and steady wins the race. Spoiler alert, sorry, if you haven't heard about that story. But that's what I'm trying to make my point is you can't expect things to grow overnight immediately, like something like this. That's why the probabilities of this happening again is very, very minimal, right? When you plant a seed for a tree and you don't see a tree the next day, it takes its time, right? And just like this, investing in your money is the same way. It takes time. You shouldn't expect it to shoot up immediately like it's Vegas, right? So yeah, that's all I can really provide some sort of advice to the listeners and viewers.
Yeah, no, and I just want to add to that, you know, we're in this time of, you know, misinformation on social media. So if you're going to learn about finance and the stock market, you know, please be careful of where you're getting your sources from. Number two, you know, as you know, you just mentioned, you know, there's an opportunity cost with everything. So either you can spend your days, you know, trying to be a retail investor and, you know, do it yourself. And I applaud you for that, really. But sometimes we're too busy for that kind of stuff, and we're going to need a financial advisor like Aiden to do that. And if you hadn't listened to our last show with Aiden, he's a fee-only financial advisor, meaning he does well when you do well. So he has that incentive to make sure that he does what's best for you, because at the end of the day, it'll help him. He's not commission based, you know, it's not something that he's just going to profit off of, whatever. So he really has your best interest in mind. So, you know, you can reach out to him, Wolfpack Investment Management, and I'm sure he'd be more than happy to talk with you.
Yeah, I'm always glad to take any type of meeting with any of your viewers or listeners. I've actually gotten some viewers and listeners to actually reach out, so I'm kind of happy about that, and I appreciate you coming onto your platform to discuss what it is that I do. And you know, at the very, very end, we all want to, you know, be like the Reddit users, right? We all want to have our part, right? But at the same time, you can't really make your part be done so quickly, right? Like you made the statement, great. You know, now this is a way for you to continue on making your voice be heard, be part of, you know, the movement, albeit it may not be as loud, but you know, you are part of what they were going after, right? They felt, you know, they felt like they needed a voice because they lost so much in '08, right? And it's natural, it happens. And, you know, all I can think about is just, you know, just be safe out there. As Samira just said, there's misinformation out there. I think I heard that the SEC is now looking into things that were posted on Reddit that were perhaps manipulating people to continue on and nudging them to keep going with all this misinformation. So at the very, very end, the person that makes that informed decision is you, the individual that, you know, if you want to invest in this or not. It all falls down to you. And really, you know, it's your vetting process that you need to create if you want to do it all on your own.
Yeah, no, it's definitely agree with that. And, you know, with that, I'd like to really say thank you again for coming on, and we'll definitely have you back again, especially with, you know, more crazy stuff that happens in the market. I think you explain, you know, things in a very simple way, and I hope my listeners agree with that. I'm pretty sure they will. And you know, hopefully we don't have something crazy like this happen again, but if we do, we know that we can always count on you to come back on and talk about it.
It feels like 2021 is still kind of like the twin of 2020 so far, but we'll see what happens. But yeah, I'd be more than happy to come along and try to explain as best as I can, in simple terms and using everyday, vocabulary, non-sophisticated, jargon, in order for your listeners and viewers to actually, understand what's going on, because essentially everyone's interested, right?
Yeah.
You want to make sure that you're providing as best as possible some sort of information that they can take some value out of it and learn from it actually too.
Yeah, no, for sure. That's great. I like that we ended on that, and because this podcast is just dedicated to explaining things in the simplest way to everyone. So thank you again, Aiden, and I look forward to talking to you soon.
Sounds great. Me too. Thank you for having me.
Of course. Thanks for tuning in. I hope you get a chance to check out the entire podcast episode. It won't disappoint. It's available on all your favorite podcast streaming platforms.